Bitcoin is holding steady above $23,000 as traders eye the Fed's next meeting. Bitcoin and ETH have outperformed equities this year as the FOMC's decision on interest rates on Wednesday looms large over the markets. Joining us now is Steve Hanke. He's a professor of applied economics at Johns Hopkins University. Professor, thank you for joining us this morning. So we did see last week, December PCE inflation, the preferred gauge for the Fed, was coming down from 4.7% to 4.4%. Also, the Bank of Canada pausing rates going forward. It seems that things are easing up. Will that impact the Fed in any way?
Well, thank you for having me back. I think the best way to look at the prospect for what's going to happen on Wednesday is to look at the Chicago Mercantile Exchange and the prices for the Fed funds futures contract. And that now is looking like yesterday, I just checked, and we have a 98.4% probability that there'll be a 25% basis rate increase in Fed funds. So it'll put us up to 4.5 to 4 3/4 as the range. So and that's the reason why it's best to look at that objective data was all laid out in 1945 by Friedrich von Hayek when he wrote his classic article, The Uses of Knowledge in Society, which actually landed him with a Nobel Prize in 1974. Prices are the key thing to look at. In other words, forget what the wags are writing about in the press and all these so-called Fed experts watching. Just look at the market and see what the market price is, because that market price is something that aggregates disperse information and encapsulates it in one simple thing, a price. So I think that's what's going to happen. Now, the interesting part of that, I think, is that it's in many ways irrelevant because monetary policy, as Milton Friedman told us, is not about interest rates. It's about the growth and the quantity of money. And if that's really what you have to look at, is what's going on with the money supply. And the money supply, in fact, has been collapsing. It peaked in March and it's contracted by 2.5% since then. In December, it actually was in negative territory, negative 1.3%. This is just unprecedented. The money supply is falling like a stone. And as a result of that, of course, what do we have? If you look at January to June of last year, the annualized rate of growth in the consumer price index was 10.7%. If you look from June to December of 2022, the annualized CPI rate of growth was only 0.3%, 0.3%. So the inflation story is essentially over, and it's over because money dominates. It's a money supply you have to look at. So you can just forget everything else. When you look at the changes in the money supply, and we know with a lag of about 1 to 9 months, we get changes in asset prices.
So do you think that the recent positivity we've seen in the markets is temporary or misguided?
Well, no, you have a struggle going on because on the one hand, the money supply is coming down and the inflation story is essentially over. That's a positive because it means that eventually, since the Fed is data driven, they're not looking at the signal. The signal is changes in the money supply. They're looking at the noise. They're just hearing the noise. What's going on with the daily data that's going out? You know, the kind of thing that you're reporting every day. I mean, why do you have a program? You're producing a lot of noise, and the Fed watches it. And that's how they disagree with that. What?
I won't disagree with that, but I need to ask this because, of course, as you mentioned, yes, it is noise potentially, but what we do have here is this: we have prices have gone up, wages not necessarily catching up to it, and we had a massive amount of fiscal spending. one would almost say reckless. One would say reckless, actually, when it came to the pandemic and post-pandemic spending, and yet we have the Fed. The rates that the Fed is charging seems to be relatively low compared to, versus inflation compared to what it was a year and a half ago, 2 years ago, et cetera. Is the Fed not being aggressive enough to sort of rein in the prices, almost deflate the prices so that it matches what wages were, so that it's, basically that the basic household goods are affordable again to people, and potentially have to cause a recession just to get to that point?
Well, again, let me just repeat what Friedman had to say. Monetary policy is not about interest rates. It's about the growth and the quantity of money. So it's the money supply that counts. And they have clearly overdone it. We have never seen this kind of contraction in the money supply. You have to go back to 1929, 1937. You saw contractions then. We have a recession baked in the cake. You mentioned the R word. We have a recession baked in the cake because we know that with these contracting money supply numbers, with a lag of about 6 to 18 months, economic activity switches around. And figure it out. The peak in the money supply was in March of last year. It's been falling like a stone ever since then. The year-over-year number is flipped into negative territory in December for monetary growth. And so figure out that lag of 16 to 18 months, 2023, we're going to see a recession. It's just, the sun comes up in the morning and goes down at night, and that's basically what's going on with the money supply. That's the signal. The noise is all this chatter about the interest rates. The thing to look at is the money supply.
Is it enough, though, to offset the amount of fiscal spending that we saw over the past couple of years? Is that contraction of the money supply enough? Yeah.
Of course, it's over. They've overdone it. They should have pivoted a long time ago. The money supply, consistent with hitting the Fed's inflation target of 2%, is about 5 to 6% per year. Now, we had a lot of goosing in the money supply. Remember, if you look at the money supply, the average rate of growth in 2020 through 2021 was 17%. Now that's about 3 times higher than it should have been if you wanted to hit an inflation target. As a result of that excess monetary growth, we got, with a lag, a lot of inflation, a 40-year high. In June, it hit 9.1% per year. Then in 2022, the money supply has collapsed. Its average growth has been less than 1% per year. So they've overdone. We're getting a whiplash, basically. They're not looking at the money supply. They've doubled down and canceled the idea that the quantity theory of money has anything to do with the economic activity and inflation. And as a result, the money supply exploded during 2020, 2021. We got inflation. And now they've overdone and slammed on the brakes. We're going through crashing through the windshield in the car, to use that analogy, and we're going to have a recession. And also, the inflation story is basically over. Now, you ask about the markets. This tug of war going on, the slowdown in inflation and the inflation story being over, that's positive, of course, for the markets. But the recession is negative because you've got earnings in there. So do you think
we'll see then, do you think the Fed will react to it eventually and maybe reinstitute QE, or is it going to continue? Do you think that they're just going to continue potentially tightening as you're showing here?
Right now, it looks like they're going to continue tightening because they really are flying blind and they're not looking at the money supply. So
25, 50 basis points the next meeting?
What?
25, 50 basis points at the next meeting. What's your outlook there?
Well, that question. Look at the
I know you
Chicago
think it's
Mercantile
noise.
Exchange and the probabilities for the next meeting. Let's worry about Wednesday. Wednesday, it looks like there's virtually 98.4% probability priced into the market of a 25% basis point. So that's I think what's going to happen Wednesday, and they'll continue on this track. But to answer your question, there could be a sharp pivot, and the sharp pivot could come from a liquidity crunch. If we have a liquidity crunch, which we've had before, by the way, when the markets really bound up, remember the famous repo fiasco we had a few years back? The Fed pivoted almost within 24 hours. So if you want to look for a fast pivot, the leading indicator will be the markets going into some kind of liquidity crunch. If you don't see that, I think they'll continue crawling along with this slow tightening and squeezing, and they still have quantitative easing, quantitative tightening on the book where they're shrinking the balance sheet of the Fed. So we haven't talked about that. We've talked about the interest rate increase, but we have quantitative tightening.
But the quantitative tightening that is happening, it appears to be relatively, it's relatively small compared to what they were doing with the easing. Do you think that are they going to change the duration of what they're going to ultimately tighten first, or do you think that they'll do a complete pivot and go straight on into
the
easing?
first thing they'll pivot on would be the interest rates, and then the second thing would be phasing out quantitative tightening and the shrinking of the balance sheet.
I also want to zoom into the crypto markets specifically, Professor Hanke. I saw that you tweeted that the SEC has charged crypto firm Genesis and Gemini with selling unregistered securities. Thinking about crypto, think again. So your thoughts on the crypto markets, not so good, I assume.
Well, again, David, you had David on there. David gave you all the technical aspects of trading this speculative asset. So I don't have any value to add. He covered it all. My view is there really aren't any fundamentals, and he covered the technicals. So what do I have to say?
All right. Professor, I think we will end it there. Thank you so much for your insights. That was Johns Hopkins University professor Steve Hanke.